All right. Good morning, everyone. Happy Thursday. Welcome, Nick. It's a pleasure
Thanks, guys.
to see you here again. Um,
Good morning, guys.
yeah. So this session is about quant trading strategy, and Nick is a good friend of mine from Miami, and we have a similar background. Obviously, you have about 19 years experience in institutional and discretionary and systematic trading. So you work for like very large firms, and now you are the CIO and founder and owner of Robin Capital Group, and also you are now launching another venture, which is Nezumia Capital, which is more like a quant trading hedge fund. So today we're going to talk about a lot of quantitative strategies, how to look at data. But before we do that, I'll let you introduce yourself, Nick, and maybe walk us through your experience.
Yeah, of course. Thanks, Fabio, and hi to everyone and the team, and congratulations to the whole MenthorQ team also for just fantastic job. You guys have been growing really fast. I've been keeping in touch with Fabio, over the last few years. So it's exciting to see all the growth you guys had. And thanks for having me. I'll try to add about as much value as I can here. So my background really, it started a while ago. I'm an engineer by design, by trade. I started working out of school, a master's in finance. I worked out of school in Santiago, Chile, for a brokerage firm. I was PM there. Very, very junior, very green. I moved to the States in 2007, started working for B of A, had some experience and, basically arrived right around the financial crisis. So it was a very humbling experience into derivatives in the entire market, which just happened to be where I fell in. For my role, moved on to fixed income trading. I was on the desk there. And then this was in Chicago, by the way. So I spent, after B of A, I spent quite a bit of time at a fund based out of Chicago, Citadel, and ended up as a market maker at Citadel Securities. That got me out to London. So that was kind of my, my professional resume before I started my own thing in 2019. And again, my background really, I kind of ventured in all different aspects of trading. On my own, I kind of went more on the discretionary side as a portfolio manager, running books for high net worth individuals, family offices. And this all kind of arose as a byproduct of the pandemic, being towards the end of a garden leave and trying to figure out life in a warm, sunny spot. And that's why I ended up in Miami. But so again, my background really is in rates, a rates trader, money trader, as you would call them. Used to make markets in interest rate swaps, dollar interest rate swaps, U.S. Treasuries. And then prior to that, I was really like overseeing a lot of algorithmic trading strategies, high frequency, primarily proprietary and market making strategies across all the exchanges globally. So I have some experience on how things work at a micro kind of nanosecond level, and then, adjusting expertise and adjusting portfolios to, I guess what you would call more at, retail consumer type, traditional type investment style, right? So building efficient portfolios and using strategies to lean into certain exposures in that capacity.
Yeah, and I think your background kind of aligns with also what we do, because obviously you mentioned that you started from a discretionary perspective, so obviously actively managing funds, but now you are moving more towards the quant side, so using more like data-driven strategies. Do you want to maybe tell us a little bit more about, like, for example, why now data is more important than ever, and how is the market changing, and how can we adapt?
Yeah, absolutely. So I guess one thing I usually highlight is like a market structure, right? It always changes. And you guys are all looking at the same environment every day, but every day that passes, it's no longer the same environment, right? So patterns in the marketplace, they repeat, obviously, but they're not always identical, right? So if you really, really hone in and you try to like microanalyze, a chart, a pattern, or whatever it is that you're trading as a strategy, you really want to look at the deviations, find some sort of middle ground, some mid point, and then deviations from there, the patterns are going to repeat to some degree, right? But there's always errors from those mids. So I guess I forget what I was going to say here, Fabio. Remind me.
Yes, like I think the importance of how finance is changing. Obviously, you come from the market making business like in Chicago.
Yeah, I'm sorry. Yeah. The point I was going to make was I've always been data driven, right? So you can have discretionary views, but you can always back test and validate things with data, and that's a more reassuring approach, at least for me. So you might have an idea and you want to test this in some way, right? In some capacity. And again, data is very, very readily available these days. Perhaps it didn't used to be. Markets are super efficient now. There's data feeds that you can get for nearly nothing. There's tons of free data that you can use. So unless you're trying to be super highly sophisticated in your analysis and the data consumption, everybody should be using it, right? And it doesn't necessarily mean that you're going to get edge from it, because it's data is essentially a commodity unless you have proprietary data these days. But it will make you feel a lot better if you've data tested, validated, a lot of the ideas that you are actually deploying in production, right, in the marketplace, your trades. So again, like we're a massive consumer of data, particularly at the hedge fund Nezumia, which is all data driven, right? Like and I'll talk a little bit about the things that I look at Robin Capital Group, and how we run strategies. But if you want a fully autonomous type fund manager, investment manager, PM, if you will, iterating and consuming tons of data is key, right? So so we do quite a bit of that.
And can you maybe walk us through, like, for those who are not familiar with it, like, obviously every year in the news we hear about these big quant funds that are outperforming the market and they're having massive returns. And I also worked for a company that was selling data to large quant funds, right? So the biggest one in the world. So all these funds are always looking for alpha, right? The term alpha is like the main topic. Like, we want to look for alpha, we want to look for alpha. Can you talk through, like, on how you approach this topic and what does it mean for you, and when you look at data as well, and how you are structuring your strategies, and also what do you do at the fund that can leverage data to generate alpha?
Yeah, absolutely. Yeah, it's an interesting one. So I guess we should start with the fact, I briefly mentioned changing market structure, right? That could be that could be something that decays alpha, right? Market efficiencies are really the higher alpha decayer out there. So like, and I mentioned patterns that change as well, right? So things are constantly evolving in the marketplace. So you do need to reinvent and retrain and recalibrate consistently, right? So the way we thought about it, knowing, especially when you work in like a high frequency environment, like it's the erosion of any edge you think you have is very quick. You have it be because it's low latency, you're not fast enough to the market, so speed and infrastructure and technology, or you're not fast enough because it takes a second to process the signal, right? But whatever causes you to miss a trade or not participate as much as you'd like to, that decays your alpha, you really have to be finding multiple different ways to re-engineer some of these things, right? So you want to have a lot of different alpha bits. You don't want to trade one pattern, you want to trade multiple patterns. Some work at certain times. You want to have an inventory of these things. And knowing that is basically what went into how we spec'd out the hedge fund. It was, we basically were thinking of this, how can we create, we know the market's changing all the time. Every day is different. Things that worked yesterday might not work today. How do we engineer an alpha factory that at any given time, we're going to have a plethora of options across asset classes, geographies, to simplify, data sets and universes, right? That we can extract these trades from. So we took the approach of, let's use the readily available data, and obviously we consume it, but let's use the cheap compute. And this is the big game changer for doing it this way, was just the advances in computation, cloud compute, and everything else. It's affordable. It didn't used to be, and that's affordable. And you can iterate and run things all day long and trade tomorrow, right? And so these were the motivations, but we knew that we needed to tackle the alpha erosion problem, because some trades are short-lived, and especially in very liquid markets, like I said, right? So efficient markets, you run out of ideas, right? So that was the motivation designed for building a big universe of tradable alphas. And then what we do is, depending on the conditions of the market, these things kind of like self-select themselves, right? Well, we designed some selection scoring process, but we trim anything down. And so the best, most consistent, repeatable trades, or alphas as we call them, we call the trades alphas in this case, but depending on the forecast, we might trade for a day, might trade for 5, 7, 30 days, depending on the outlook. That is the trade that we're going to give capital to, and we're going to allocate, and then we're going to mark it out every day, right? So that's kind of the way we thought about this alpha erosion, and constantly finding trades or strategies or ideas or alphas that work, right? So that was actually like the main thing we were trying to tackle, just knowing how a lot of these funds, they have a good year, or they're expecting certain market conditions to have a consistent performance. And you see it, right? You see last year, the macro funds, were semi-okay. A lot of the quant funds last year during the first half, not great, right? Like correlations broke down. You had stocks and bonds move in the same direction regularly. So you have all these, all this noise in the market. And if you're relying on some mean reversion, which is, by the way, most of these like quant shops, the underlying principle is like something has to go back to normal, whatever that normal may be, in whatever time frame. They're expecting this to happen. And so when things move, together, then these things fall, they break down. These models all break down, right?
And
so
the most interesting part, Nick, when I was selling data to large funds, was that not only you need data that can give you alpha, but you also need data that is uncorrelated to maybe something that you already have, because then you can build up on things that might move in a different direction if the market changes. So like a lot of these funds are looking for things that are not correlated at all with what they have, and they build alpha with the non-correlated factors.
Yeah, yeah, I agree. So anything alternative data or like feeds that, and again, this is where like the today's compute machinery and just all of the ease to market, if you will, like to plug these things into different types of models, really facilitates experimenting with these things. To be honest, we really stick to the core. We stick to price data, volume data, on very, very liquid assets. This is the other bit. You need very rich data sets for anything on the quantitative bit to really provide some value, right? You need a lot of data points. So we stick to the highly liquid bit, but introducing alternative data sets, or even proprietary data sets, or first some sort of process data set that you might have could be an input for So anything that continually is extracting some value, right? Some measurable value, could enhance what you're looking at.
And how important is, of course, leveraging technology, artificial intelligence, but also back-testing some of these strategies? And what do you look for when you're back-testing some of these factors?
Yeah, I mean, yeah, consistency, right? So just by definition, you do need to be careful when you're building these things to not overfit or overly massage. Like, it's funny. my CEO at Nezumia, we worked together in the past for quite a long time. And, it's just like incredibly methodical. And anybody who's like a quantitative researcher, like, big brain, like are this is a clash, right? Just for context, I'm the guy in the front facing the street. I'm the trader, I'm the PM. And then, we would always be backed by these quantitative researchers who are overthinking. They're paid to overthink and like to just make everything as precise and smooth and as possible. But a lot of the time markets aren't, nice and smooth, right? It depends on the asset class, but like markets tend to be very choppy. Prices are very choppy. So like when you start to, you can overly, you get too sophisticated, if you will. And it ends up, one, costing time, two, not really getting you much, right? So the overfitting and it is a real thing in models. So you basically just have to be careful when you backtest to make sure that it's just a good predictor of the future, right? Like you build something, don't train on data that you plan to be. I mean, it's a very simple concept, but like don't train on data that your model has already seen, right? Like see how good a predictor your model might be of data it hasn't seen, and look for consistency, minimize errors, like just iterate about as much as possible in every which way. But yeah, I mean, overfitting is a big risk in dealing with this stuff.
Yeah, maybe Nick. So we do a lot of data on options, and for us, it's important to leverage our model because, especially in the option market making is key in driving not only liquidity but also potentially price action, given the market structure, how the market works. Maybe you can share some insights about maybe what you've done when you were market making, and I know you were more in the kind of like treasury space, but maybe it's interesting to understand the things that you were looking for and how you were planning your day as a market maker. I think that could be interesting.
Yeah. I mean, I'm happy to share what I can. I guess specific to futures, one thing to consider is, I guess, what is market making? Like to me, by definition, it's quite simple. I'm just going to show you two prices, right? I might have some alpha that wants me to trade a certain, on the bid or on the ask at any given time. I'm going to show you the price closest to mid that I want to trade, right? So, and I'm going to charge you some bid offer for the one that I don't necessarily want as much, right? Within reason and still in a competitive market. Market makers, like their business is to collect bid offer and exhaust risk and pass it around, right? Like they don't want to hold this stuff. So like leading into events, if you're truly market making and not taking proprietary positions, you should expect them not to want to hold anything, right? Like during a risk event, you want to charge more. You almost don't want to encourage trading, right? So I mean, you do at a price, but it has to be the right price. So like if you're trading at a penny wide, you might in equities or anything else. But if you're trading at a penny wide, you might widen out a little bit during that event, right? Because that instant volatility could potentially be costly, right? So by definition, market makers don't really want to hold these things. It doesn't mean that they don't, because they do have to exhaust it, right? They get filled in a big position. They need to skew their book and then start to show a more favorable bid or ask depending on the side of the trade they're on, right? Like just to exhaust it. So they want to transfer that risk out into the marketplace through subsequent trades. But they shouldn't be really taking a market making position on any event. It doesn't mean they won't get stuck with a position, but they're not leaning into it as opposed to a proprietary firm, right? Like they might want to express that risk depending on what's going to happen, right? And then ties closer to, a lot of what you guys see and what you guys are doing, right? You guys are trying to trade those events. So yeah.
The goal of our model is really to look at similar to what you do with your strategy. We are trying to use the same approach used by quant firms to extract alpha or insights from a data set which is very available, but it's very hard sometimes to manage, which is the option data. We also look at options on futures, so which is a key driver of our business. And basically, we're trying to extract, similar to what a quant fund would look at that data, like how can we predict where the price could go tomorrow, or how can we predict if the price should stay within a range in the next 20 days, so that you can actually use options that are non-directional, flexible instrument where you can make money not only if the market goes up or down, but also if the market stays in the range. So this is kind of like the goal of what we do. So we build quant models for that, and we also monitor closely what market makers might do when they are trying to hedge. So when when the volatility increases, like what's going to happen to those events, and how is the liquidity changing? So market positioning and stuff.
Right. Yeah. So one thing that comes to mind instantly is, if you offer this, hopefully at some point, because I think it'd be a great exercise, but if you have your levels and what you publish on a specific instrument, if you have a time series of it over, if you have some historical, you can easily plug that into some sort of backtest, and all of your users could potentially optimize their strategies, right? So, and just see what works and when it doesn't, right? And then that's kind of your calibration to what you're doing, right? Because again, like the one thing I know with certainty is that the market's always changing, right? Like, and so these patterns change. They constantly they're dynamic. They evolve, right? Like participants change. Sizes trades. I mean, you look at market structure today and just look at the S&P and the weights. Like it's absurd, right? Like there's no, the market is there's a massive liquidity premium in, or I call it a liquidity premium in top 7 to 10 stocks, right? Like it's nuts, and that's why everyone kind of gravitates towards these things. But it's always changing, so you do need to evolve with it and constantly, just pick away at what it is that works for you, so that you still have a fighting chance, right? And know what you're up against too, because that's the other thing, right? If you use one of these, like one of these little mouses, it's very hard to contend, right? To fight a lot of these sophisticated players, right? So like automation, trying to be systematic. If there's a way to encapsulate what you're doing on a discretionary basis and just translate that into some sort of like simple strategy, right? Just to execute quicker or more efficiently, or it ends up saving quite a bit, and you see that that compounds into your returns, right? So or your P&L, however you make it.
One of the most important things is also taking away the emotional bias, because I think, like, obviously as a human, we are obviously more inefficient than technology. So sometimes we have a bias and we don't see the data around it that tells us that we are wrong, right? So I think using a systematic approach sometimes can be better, because you're leveraging data instead of leveraging emotions, which sometimes can lead to mistakes.
I couldn't agree more. That to me, that's like the that's the hardest one to like. Well, it's the easiest one to realize, but it's the hardest one to overcome, right? Because we are emotional by definition, humans, right? And so we all fall into this kind of all the bad that we have, and this is why algos are better at doing a lot of this stuff. We fall into groupthink, we fall into confirmation bias. We're late to things. It as a discretionary PM or trader, like especially as a trader, that's really, and I some of your podcasts, you guys mentioned this as well. You really have to take all the emotion out of this, right? Like you have to be systematic, even if not programmatic, right? Like you have to have a system, some kind of checklist. Manifesto is like a random book that kind of talks to this, but just be methodical, right? And then take the human element out of it. Like I can't stress how important it is. And if anything, that really just makes you consistent, and it starts to like really build on your conviction as you do this for longer, right? Especially guys starting out, it's but yeah, just stick to the plan, basically, is what it is, and be honest with yourself. What a lot of people, in the street don't do is mark themselves out, right? So, you can always mark out your trades and see how you did. Did you enter at the right time or did you not, right? Mark yourself out first. What was the price a minute later, 5 minutes later, day later, right? Like whatever frequency, but because that's the only way to get better, right? So, these are things that are helpful. It doesn't eliminate the human bias, but it's helpful to kind of turn yourself into a robot, if you will, when you're looking at this, because, you don't want to be influenced by anything.
Yeah.
It's also, I think the best traders also have this element of solitude. The more people you speak to, and I don't know if this happens to you guys, but the more people you speak to, one gravitates towards those that kind of confirm what you're thinking, right? So, you'll find yourself having a beer with people that all agree on your stock pick or your trade, and it's opposite to what you should want, right? You should want to dialogue and like debate your position all the time. You should constantly be living in fear and paranoia, especially if you're running risk for a living, right? Like I want people to tell me why I'm wrong, and then I feel better about that because I'll do the work to just make sure that may or may not be the case, right? So it could be a lonely. It could be a very lonely. You're better when you're lonely, I guess, if that makes sense.
Makes sense. So here we see like some charts from kind of like your internal tools, your fund. I think you do a lot of macro. So when we were talking in Miami, you obviously care a lot about macro because also your background is in macro. Do you want to maybe like share on some of the things that you look for at the macro environment?
Yeah. So outside of the very data-driven approach where, you assume everything is in a price, so, interest rates, price of oil, geopolitics, fiscal, whatever, one can assume the price reflects that. And then you take that, you build models and you look for statistical relationships, right? At a discretionary level, the macro bit, to me, really starts with like the cost of money, right? So where are policy rates, interest rates? And that's usually where I start from, like a top-down type approach. So I look for relationships that, short and longer, that kind of, historical correlations, if you will. And there's just like a, silly looking correlation plot there with a lot of ETFs. So I run an ETF strategy it's essentially long only. And I didn't mention this, but I run SMA. So like I've got restrictions on what I could do, right? So given the confines of my investable universe and some of the client accounts, I basically have to optimize the portfolio with the trends and different things that I want to, exposures that I want to put into the book, and then just optimize to that, given the fact that I can't necessarily take it short or, so I have to get creative, right? Like it's a big kind of engineering exercise for me. But we carry cash, to kind of offset some of the lack of shorts I can put on at given times, right? But anyway, so yeah, historical correlations, how these things change, deviate, always looking for trends, money flow, international money flow from, one place to another. That obviously translates to FX. I know you guys trade FX as well, but, looking at interest rate differentials between economies, like obviously like is instantly reflected in the FX market. I don't tend to use a lot of technicals outside of very, very short type. Okay, we're going to execute here, but these things, I'm also not day trading. I don't like, I'll trade daily, but I don't day trade, right? So like I've got like a core, I build a portfolio, have a core, and I'll rebalance as things kind of fall out of line or in line or things materialize. So that's really it. I'll turn the books around, 3 to 4 times a year on average. And I'll do that in rates. I'll do that less so in rates, to be honest, because that's it's a very conservative portfolio. But yeah, the macro strategy, I'll turn 3 to 4 times a year. And then we have an equity portfolio, long only equity portfolio. That one's a bit more active. And similarly, so, I look for trending fundamentals when I look at stocks. So basically just have sort of semi-automatic kind of way to view the big picture and make sure that, things are steering in the right place. Interest rates are high. We don't want companies with a lot of debt, debt maturing, coming due. We want to see like growing revenues, growing EBITDAs, like, nothing groundbreaking, but we do capture those trends and then hope that there's some sort of catalyst that sparks a little momentum in the underlier, right? So those are kind of the things we're looking for. And then we weight them in a portfolio to kind of optimize and make it efficient, right?
How do you deal with like earnings and catalyst events like that? Like, how do you maybe?
Yeah, I mean, again, it's look, you try to predict, but like all the predictions in earnings, and again, I'm not going to pretend to be like an equity analyst who's like on the phone with all the companies all the time. I do occasionally, like depending on how important that position might be to me, but yeah, I mean, you just kind of wait and see, right? And it's kind of a reaction function. If the trend breaks, or if they, there's seasonality, so you can adjust by that. But my guess is as good as anyone else's. What Amazon's going to report, right? Like, but again, a lot of the trends do confirm. But I'm not trying to. I'm already in that trade, right? Like it's going to be a little bit longer term, so I can hide behind that. If there's a big break and something falls apart, then there's risk management, obviously, as well, to kind of cover that gap. But I'm not I'm not trying to predict earnings, right, for a specific company. It's and this is the importance of having a structured portfolio that you can afford to have something go down, and then it's going to be decently diversified at least, right?
Is there a specific sector that you look for? Like, of course.
No, I mean, I tend to look at anything that it has good management companies, but no sector. I'm not sector specific. I've had plays on oil producers, oil service companies, a lot of technology, and mostly because I'm usually in it myself. So like I tend to explore and experiment a lot with like new companies and new things that come out. So alternative technology, right? I rarely ever owned any of the Mag 7s. Like last year, these things ripped. I own nothing. We perform quite well without any of these things, but alternative companies, small companies with talent. Like I look for liquidity, obviously. So I'm not looking at small, very micro cap, nano cap companies. Anything, and at least small, maybe $1 billion market cap kind of thing and above. But it's more about what they're doing. It's more about the innovation in tech. But yeah, I mean, I'll look at everything. Housing, retail. I'm not sector specific. Like it's more, this is the bottom up approach, really, right? So it starts with rates, trickles all the way down to trends. And then within those trends that I might find in an ETF, I might scrub through and look for some specific companies that I think are on the right track, right? So spend most of my day doing research, really. That's what it is.
That's awesome. And guys, like, if you have any question for Nick, feel free to send them over. I think this is a good chance to learn from someone who was managing a fund, his own fund, and also has been very successful in the industry. I remember you outperformed the market almost every year, so which is awesome.
Yeah, look, knock on wood, right? Like trying not to be a one-trick pony, but yeah, it's like when you start off on your own, it's a blessing and a curse, right? Because it's usually your friends and family are the ones that support you the most, and those are the last people you want to upset. But yeah, look, it's just we've been very, very, very methodical in terms of how we've grown. It's been very natural. And the other bit is, and I think this makes a difference, just as a side note to anyone looking at it, but having skin in the game is the main thing, right? Like, I'm not in it for obviously we have to survive. We charge some small fees, but like we're definitely way more affordable than your traditional, financial advisory firm or, asset manager. And again, it's just a function of being small, but mostly skin in the game. Like if I don't perform, I've got a life, as you know, Fabio, and, kids to feed and all that. Right. So, it's just about being consistent and methodical, really. But fortunately we had a great year last year. Things worked out, and I'll forever remember 2024 as the grindiest year I've ever had in markets, because it was impossible the first half, and then like most, I think, most books kind of snapped out of it leading into the end of the year, and then it worked out. But you just got to stick to it. It's
and
above else, manage risk.
So how do you see the future, Nick? Like, obviously, we are now in the AI era, right? Things are changing so fast compared to the past, and also this is gonna be applicable to finance. So we're gonna get to a point where AI is gonna be with us in the finance industry too. So like, how do you look at the future, and how do you think about the future to also stay competitive? Because
that's a good question, man. Maybe one day my AI is competing against your AI, right? Like, and maybe things start to go a little more black box, even more so than they are now, right? For like, it depends, right? Is it a speed game? Is it not? You got to remember, there's a lot of middlemen here are going to suffer as well, right? Because as the exchanges get more sophisticated, and a lot of the specialists and the market makers and the liquidity providers, like these guys are all fighting for, these trades, this bid offer, and eventually, like, bid offer is tiny, right? Like in equities, it's tiny, and rates, it's gotten very small. So it depends on the asset class. Like, so for these like highly deep liquid markets that we all operate in, I think it's just more and more automation, more sophistication. Like humans are going to get squeezed out of this space more and more. It doesn't mean you can't trade in them, but you're going to want to do it in a more automated way. So, right. But I wish I could see it a little further out in the future, but I think the rate of change now is just, I see it. It's just exponential, right? There's no reason why we're not using all the tools at hand to quickly get to market and expedite and optimize, right? Like, you can almost get away not even being very technical these days, right? Like, you don't have to know how to code per se, right? Like, which was massive growing pain for me, like, early on, and eventually you do it enough and you learn, but like, you don't even have to do that now. So like, you can really like outsource most things to the tools at hand, like everything that's blown people's minds, right? All of these like, LLMs and different types of platforms will do this for you. So I think the future is going to be like, it's going to evolve even quicker now. Like that's kind of where I am. So again, focus on what works and have an inventory of tradable strategies, alphas, and then just, every so often test them out and make sure that they suit the current market, right? Because it's going to be different very quickly. So you just want to keep up, and how you look at the world.
Absolutely. Let's see.
Yeah.
We've got some questions. Yeah, guys, send us any comments, questions. I don't know, Nick, if there's anything we missed that we should add, but
look, different iteration, or there's happy to take any questions on the side too. If you want to share my email, that's fine too. This was kind of high level brushstrokes of the world, but there's a lot of details that go into a lot of these things. So happy to share.
Yeah, so like most of our users and customers are retail investors. Maybe like any advice that you have from your institutional background for somebody who is now approaching trading, and obviously trying to leverage data, trying to create a strategy, trying to kind of like make trading as their full-time profession? Someone like the things that you might want to give?
Yeah, I mean, yeah, I would say start small, start humble, start on a paper account. You know, and you have to grow into your level of comfort, right? Like it takes a little bit of time. If there's one thing everyone has in common, and regardless, it's like nobody likes to lose money, right? Like and that will happen. The market will, it's happy to take it from you. So, you know, just stay humble and don't get too confident ever. Like you got to stay on your toes, be paranoid. Definitely don't be complacent when you start. But with that, that like learn, study, see what works, and mostly like just again back test and make sure that you make yourself as comfortable as you can with whatever strategy it is you're trying to deploy, because the market will also show you opportunities where if you gain that level of confidence and conviction, then you know the world's your oyster. You can trade that all day, right? So just be cautious, but cautious, not overly afraid, is really, I think, the approach. And yeah, I would adapt and integrate as much technology as you possibly can to validation and back testing. And this only makes you sleep well. You know, like this is equivalent to an equity analyst who knows the ins and outs of a company, and stock goes down. You know, what are they going to do? They're going to buy more, right? Because they know this. You know, it doesn't mean they can't. It doesn't mean they're not wrong, but you know, this is an opportunity. You give me a gift to buy something that I know very well, right? And it's the same thing at any time slice that you trade in, right? So have that be sub-second or, you know, days or weeks or years, it doesn't matter.
Yeah, that's awesome.
Yeah.
All right, let's see if we get some last question, guys.
No questions, Fabio? We either explained it well or or everyone's out for a walk and a coffee.
Yeah, no, I think this was great, Nick.
Look, happy to help. And again, I'll be looking at your gamma levels too fairly soon. So
I don't know if you can say anything about peak 93.
Oh, what type of trade annoys market makers the most? Oh man. So a good market maker doesn't really get annoyed, right? Because their price is going to be just fine, right? Like, again, remember, like I'll make you a market right now on anything you want. And if I don't want it, I'm just going to skew my mid, right? So like my midpoint is here. This is the fair market price. As a market maker, I'm just going to show you a really good bid if I want it, because I know you want to take my offer. So you're just going to have to pay me more for it, right? And this is what market makers do all day, right? And it depends on how they're managing their inventory. If they're in a trade, they want to exhaust it. They want to get out, right? Like they'd rather not make money and just get out of it for free to keep the bid out there, right? So, I mean, I could share like. I was annoyed as a rates trader briefly in swaps, because you've got a lot of like very, very technical, highly special, very smart people like that work in hedge funds, right? And a lot of the time, you know, they just want to make a buck, and they'll do it at the expense of a market maker. So when you're trading in size, you know, and this is like institutional size, like I traded dollar swaps, for example, around events, you know, prices snap, right? You guys see that you're trading the event, but like think of all the prices that future snap, cash bonds, everything that you use to construct your curve, which is also ultimately my mid price, right? Like these things have these burps, right? Where like you don't get a price feed, you know, instantly. Your curve is messed up. You got to reprocess the whole thing. You might have a little kink in your curve. And so the most annoying guys would be the guys that come in and ask you for a price on that kink. And if you don't pick up on the fact that your market data is not like fully up to date, you might make a wrong price, and that's going to cost you a pant load, right? So those spivvy traders, I would say, I recall, and you learn, you know, you take them out for beer, and then you realize who they are, and then it gets a little better. But those guys were predictable over time. But you know, sometimes, you know, everyone gets caught on a few things. So yeah, the guys that come in like right around really noisy market data things, and they just know where it is because these things always snap back. You might make the wrong price as a market maker, and then by the second your curve snaps, you realize, oh man, I priced this off by a 20th of a basis point, a 10th of a basis point, and that's very costly, right? Because we're operating in markets that, at least swaps markets, were 0.3 of a basis point wide. Like there's no room for error there, right? So a little kink on a fig trader's curve, and you get the hedge fund guy just trying to rip your face off. Not the nicest thing, right? And there's not much you can do aside from next time you ask me for a price, you know what it's going to look like, right? It's going to be this wide. It's like that's a polite way to tell you where to shove it, basically. But yeah, so nice. I would say that's probably the most annoying bit.
Makes sense. Thank you for sharing that.
Yeah.
All right. I think this was awesome, Nick, and I hope to have you again on another session, maybe.
Yeah, I'd love to. Listen, I'd love to. We're check us out, Robin Capital Group. We're based in Miami. We're always trying to grow. If you have any interests, from vanilla to as sophisticated as you want, and with Nezumia and my partner Patrick Huggins, we're going to be we're shooting for a launch for this fund, hopefully come March. So we're going to be doing a little roadshow and hitting the streets, and just follow us if any interest or questions. We're out there. We're coming out of stealth mode, which we've been in for quite a while. Just enjoying the Miami Rays here, but we'll be on the street pretty soon and back at it. So yeah, and happy to share. And thank you for having me. I don't tend to do this often, as you know, Fabio, but
no worries. So check out the Capital Group, and check out the site. Reach out to Nick if you have questions. I think it's great. I mean, I've seen your growth over the past 4 years, and you've been building technology, and now you're going full on the race, so which is awesome. And good luck with everything.
Thank you, my man.
Awesome.
Thanks, Fabio.
Good day.
Thanks, guys.
Bye-bye.
Have a great day. Happy trading.